In the fixed income market, we saw an equally wild roller coaster ride. The fixed income markets in the end of March and early April really were disrupted, and we were seeing big losses. They have recovered. Fixed income is going to be a tough road. We're in a near zero world of interest rates all over the world as stimulus comes in. And so how do we find value in a near zero world? What's interesting is traditionally one way to get more yield is to go out on the credit side and take a little bit more risk. Now, we saw a tremendous pullback. This next chart shows you look at where spreads were. So a spread is how much more interest do you get over a treasury. If it's 1% more, that's 100. If it's 10% more, that's 1,000-point spread. And so when we look at this chart, we see a year in 2019, the spreads were very low across the board, all below norms. By the time we hit March 31st, these spreads became enormously large. So for example, global high yield, 1,000 points. That is a recession. That is severe stress. High yield here in the U.S., 880. Energy, 2,000. Oil went negative. Let's not forget this moment in time. Oil went negative pricing. Unbelievable. Never seen anything like it. Even credit, investment grade credit, really got into the 300s. Look at today. Look where we are. That is all settled down. It's not where it was, but it's significantly better than what it's been. It's stabilized. So yes, there are areas to reach out and get a little more yield, though we would caution. There's a lot of risk here. So we're not going out to the high yield world. We think investment grade looks great. We do like emerging markets, but this is a time to take note that things are stabilizing, but we're not out of the woods in terms of credit risk. So in a QE world, quantitative easing world, what we know is 12 months later, high yield makes a lot of money. Leveraged loans, which we have put money in, make a lot of money. Investment grade does very well. And so if we just looked at history, we would jump right into some of those areas in the fixed income world. Remember, high yield is a junk bond. However, the next chart shows we do need to be careful because when we look at the upgrade to downgrade ratio, okay, what are credit companies rating these bonds? Are they going up or down? We see we are really starting to get low. 2020, one of the lowest ratios that we've seen in a long time. So that tells us the credit agencies are worried. They're downgrading bonds. There's risk in the marketplace. Our synopsis is really quite simple. We're going to take risk only where we are confident that the reward is appropriate, and we're not going to go chasing a high yield just because interest rates are low. That brings too much risk in the portfolio. Stay short, stay safer, high quality matters.